Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we have our favorite, the Primary Vision Frac spread count, and then we're going to go through just around the world, what are some of the things that are happening with a bigger focus on China in terms of what are some of the updates that we've had for floating storage, for crude in general, and then we're going to turn back to the US and just wrap up with what did the inflation numbers show today, what do we see happening throughout the rest of the year, and then obviously into next year, and then again looking at University of Michigan consumer sentiment. So now getting back to the fun side of the frac spread count. So the frac spread count fell by 4. Again, as we said last week, this is very normal. You know, we typically have this slowdown that really goes until the new year. And then once we get into the first or second week of January, we get this big snapback. Typically, second week of January is where you get that big snapback, and you're typically coming close to where you started December is where you'll be by that second week of Jan, just to give you an idea of where we'll normally shake that out. But during this time period, we don't see the same on the rig side. We see rigs continuing to accelerate, and that's going to provide a little bit of that uplift, especially as we get into Jan and Feb, when you think about DUC count, the amount of running room that's being created. Because even though we did get a reduction in frac spreads, we had an increase in the Permian, and that's something where we will see some slowdown in the Permian, as we always do. But you're just seeing that I think the activity in that specific location is going to remain elevated up until essentially for maybe a 10-day period, where assume Christmas Eve until about New Year's Day. That's when you're going to get that slowdown. So things should stay fairly strong in the Permian, which is why we've also been saying that the drop on a seasonal level won't be as severe as it has been in previous years. We're starting from a lower number, 274 was the peak, so that drop won't be as severe. And as we had said last week, we were assuming that a drop from about 25 from that 274 number. So when we look at rig counts, just kind of reiterating what we've been talking about, here you can see horizontal rigs were up by 8. We lost 1 vertical, so the total increase was 7, 4 in oil, 3 in gas. So you're seeing, again, the vertical comes in, those get laid down, then you see the horizontal come through and finish up those DUCs for the frac spread to come behind it. So we do expect this to remain elevated and continue to stay strong through year end and then well into Q1. But some of the things that we were talking about and we've highlighted in the insights is some concern around what are steel prices doing, what are some of the pipe prices doing, and how is that going to be accounted for as we go into Q1 and Q2. Now, when we turn to China, just because we want to look at what are some of the flows that have been occurring, here you can see the fuel oil stockpiles are at a new all-time record. It's just blowing through numbers on for 2021 for going back through historics. So again, we expect them to start increasing some of their exports of product, trying to manage some of this storage, because right now their oil storage has come down a bit, but products have just blown through the roof. So they're going to want to try to manage this as they go through and make sure that they obviously have enough for winter in case there are issues with coal availability, natural gas availability, fuel oil can back into that. On the other side, a new partial lockdown has been rolled out in Ningbo, which is the third largest port in the world. So again, it's a partial lockdown. They've kind of closed loop is what they've been talking about, and the closed loop management to be imposed on Monday. So you will start to see some of these shifts. Again, supply chain isn't going anywhere. This is going to be a continuous issue, especially as we go through winter. And then it will be something that'll pick back up and hopefully start to normalize as we go into Q3 and Q4. But again, this is just another example of a huge issue as we continue to get these spits and starts, especially in China. So then when we turn to oil, here you can see, as we've been saying, we expect crude storage, especially in Shandong, to just be flat through year end. We might start to see a little bit of a creep up, especially given the amount of imports that are expected. So over the last 5 years, China's supertanker crude imports are at a record, seasonally adjusted record, at the highest level in 2021 that it's been at since March of this year. So this is also happening at the same time that you're not seeing a lot of Asian buying, where and again, because typically China buys from is a big buyer of Angola, of Congo, and we're starting to see a slowdown again of January. And we never really saw a big pickup. We saw a more normal schedule being bought in December. And here you're seeing that China is really taking advantage of, well, what was in floating storage? What can I get a deal on? So you are seeing a big increase in imports over the next 2 months, just based on timing delays. But we're not seeing a huge a growing tightness in the physical market. Instead, they're being specific and picking up some of these floating storage assets. Now, when we turn to what we've seen on the product side, because remember, we try to give some color of what we expect on Wednesday during the EIA show. Here you can see Singapore is right in line with kind of what we were thinking on the total side. Residual had that bounce that we were talking about, where middle distillate had another drop, and we were expecting to see this have a small bounce. Light distillate, kind of sitting here, but the middle distillate is the bullish one. That's the one that we're going to want to watch, because right now that is showing something that is very strong, while the other two are a bit normal. Resid coming in a bit bearish. The middle distillate side is going to be the one to watch. How are things setting up? Where is diesel demand and that middle distillate showing? And we do expect to see some of this makeup number, but again, that was a strong backdrop. Now on the European side, you can see a big increase in gasoline storage. This will just open up a bit more of these exports from Europe into the U.S. And as now we're back over a million. They're going to try to manage this more aggressively, so we should see that open back up. Gas oil finally had that build that we had been talking about, that we had been seeing, and just the boats, timing. And then fuel oil has finally started to see some of those movements offshore. We expect that to kind of continue. Not so much gasoline. Gasoline we think will hold here. They'll manage it again based on some of the falling demand there, some of the movements back into exports. Gas oil will creep higher, very slow, steady. We don't see a huge move, but they will try to accelerate some of that fuel oil into the market. Now, when we look at the loading schedule, if we don't get an increase in the Russian numbers by really the middle of next week, then we can just assume that 4 million will be the number for the month. Typically, we might get some one-offs, which will again push us a little bit closer to what we were thinking of about 4.1. But being over 4 million, this is the most since April of this year, and then before that was April of 2021. I'm sorry, March of 2020. So you're getting an idea of how elevated Russian throughput really is. Angola has yet to sell 9 to 10 cargoes of crude for January. So things in December were fairly normal. January started out fairly normal versus December, but things have really started to drop off. And when we again harkening back to what we were talking about with crude supertanker, China supertanker imports, that's where we're getting some of this restriction. The same thing is playing out in the Congo. They still have 2 shipments available, which is something that they were assuming to be to move through. So trading activity has been somewhat muted over the past week, partly due to lower buying activity from China's independent refiners, which is weighing on West African differentials, which is something that we've been talking about. On the India consumption side, India's oil product consumption in November fell 11% year over year, down the most since August 2020. Gasoline was down 70 basis points. Diesel was down 7.6%. Naphtha was down 19%. LPG, or liquid petroleum gas, was just down 40 basis points, and petcoke was down 12%. So the diesel remains the biggest concern, but when you look at what's happening in Singapore with that middle distillate, you're seeing some of this conflict. So diesel is going to be the one to watch. Gasoline has been fairly strong, But gasoline total consumption in November was 2.65 million, where diesel was 6.5 million. So even though gasoline is very good, it's they're showing the consumer is active. The bigger issue is on the diesel side, because that's more a proxy for the economy, the industrial sector, and we're still seeing a lot of sluggishness, especially in India. Now, if these levels continue, we would expect to see a little bit more of an export focus on the middle distillate, which again, we want to hone in on Singapore, because that middle distillate is going to be the very important side. Now, on the positive, we have seen some price premiums coming back into the North Sea, and Fortes, as we said on Wednesday, it dropped 25 cents. It is now up 15 cents from the 25, so not fully there, but you're starting to see some balancing act, some movements. Traffic is actually moving some crude into China, which is going a very long route, which is not normal. But again, China is being very specific and trying to take advantage of some of these crudes that have been in floating storage for an extended period of time, things that they want to move through. So again, this is going to be something to watch. Now, when we turn to CPI, November CPI came in at 0.8% month over month versus the estimate of 0.7%. And then when you look at it year over year, 6.8% versus 6.8% estimate, so right in line. Core, again, right in line. All of this, as we said, November, we expected to finish strong. And then December, because the end of November started to see some weakness, and we expect some of that slowdown in December. And again, it's the pace. We expect the pace of inflation to slow. We're not going into deflation. It's just the pace of additions is going to pare back something closer to 0.3, 0.4. And then that'll continue into January and February. Maybe February, you get a negative 20 basis points, but it's really going to be then start to reaccelerate March through the summer. Looking at the 12-month backdrop, here's the thing that matters the most for when we're speaking about Powell is that sticky inflation. So sticky inflation coming in at 3.4%. When you look at the trimmed 4.6%. All of these are key components, and the problems that we're seeing, which is not going to reverse anytime soon, because that sticky inflation continues to shift higher, continues to get pulled up. And that's what the Fed is looking at when they're trying to make policy and trying to come up with when should they raise rates, when should they accelerate tapering. And I think this picture right here is screaming that they're already too late. So then when you look at the CPI minus the 5-year average, year-over-year change, you're getting an idea of just where we are. This is the highest inflation we've had since, I believe it's 39 years. This is the highest it's been since 1982, just to give you an idea of just how far back we have to go to see some of the pace in this acceleration. But they're still buying $120 billion worth of bonds every month, which is why, again, we need to see this acceleration, and there's more and more affinity to do so. And one of the reasons why I think this is a really powerful chart, and one that we talked about in our insights today, is the PPI, so the producer price index. And we want to look at what are, where do we import most of our stuff? We've been exporting our supply chain for so long. So where do we import from? China, Japan, South Korea, Germany, and then we just took the Eurozone aggregate. And here you can see that PPI, so even in Japan, in a place where CPI is still negative, PPI is at 9% year over year, which is the highest it's been going back to 2001. So you have China, which is the highest it's been going back to 1996 at 12.9%. Did it pause? Yes, it paused, which is what we were saying it would, but it didn't come down. And this is, again, when you take PPI into wholesale costs, into wholesale prices, into the export market, this is where you get that elevated price, where even as the supply chain gets better, this is going to keep that stickiness in some of these price increases. You've seen the same Japan to a record. South Korea, the highs that we saw in 2007. Germany, all-time high. Eurozone, all-time high, bringing the U.S. also into an all-time high. So again, all of these things, all of these metrics are just going to provide some of that tailwind for these inflationary levels. And then when you look at that sticky price, when you look at the sticky price underlying it, you're seeing that that's being pulled up going back to 2012. You see this just creeping higher, which is, again, being pulled up by the flexible. Flexible is not going down. The pace of the flexible inflation is starting to slow, but that doesn't mean that the sticky inflation is going to slow down, because that, again, is calculated a little bit differently. And once it gets in motion, that's going to take time to stop. So here you can see that on the flexible side, everything is breaking to new highs, going back to 2012, going back to the highs from 2021. Again, more and more of that pressure. So when you think about wages and how wages have reacted, they just haven't, even though they've gone up, they haven't gone up enough. So when we take in and factor in inflation, hourly earnings were down 1.9%. And this is where, again, a backdrop of support for that sticky inflation. As the supply chain gets a little bit better, some of the companies have a little bit less cost on the supply chain side. They're going to funnel some of that money into wages. So you're really not going to see prices come down. It's just the cost is going to be spent in different areas, which again is going to try to arrest this. But as this continues to weigh, as this continues to pull money out of savings, this is where we see that accelerated drop in retail sales. And just putting it into perspective, so this is not factoring in inflation. So here you can see the first quartile, essentially the lowest earners, continue to see a lot of strength, while on the fourth quartile side, or the wealthiest or the highest earners, that continues to fall. But you're starting to see this, again, level off on the overall side as you get this competition back and forth. But as it continues to miss against inflation, that's where the pain is really going to arise going into next year. Household wealth on the other side, net worth has gone up. Even when you factor in inflation, it's still elevated. And again, as long as you own assets, as long as you have a 401k, you've been able to weather the storm a bit better, which is why household wealth, as calculated, factoring in assets, have gone up in value. So even though inflation is at a record, so are home prices, so are other prices, stock prices, the S&P 500, the Qs, or I should say the NASDAQ. As long as you've owned a basket of that, you've been able to weather the storm a bit better. So then when you start looking at University of Michigan consumer sentiment, it had a nice little bounce. But again, remember, University of Michigan is still well below consumer confidence, and we expect this to meet in the middle. It's still at a low in comparison to where we were in 2020. Just to give you an idea, people are still concerned. They're as concerned as they were during the start of COVID, and expectations still remain low. But again, we don't expect it to continue to drop, but kind of find this comfort point, because wages are still creeping higher. So even though you might not be able to spend as much, you're seeing your wages go up, your income starting to normalize. You've seen your asset worth go up as well, and that's been able to buffet some of the drop, which is what we see here. We're still at 2011 lows for consumer expectations, but you're seeing some stability, which again is kind of that counter to some of the issues or concerns that we're seeing on retail sales, which is why the consumer can stay fickle. And so we'll try to always figure out, what is happening. We'll play both. We'll show you both sides. We do think that retail sales are gonna slow. We are going to see the consumer pull back, and it's really based on savings and that real cost increase, that is increasing the cost of living. Google has announced that they will not be matching all wages back to the cost of inflation. So again, you're going to see some of that back and forth depending on if your company does. That'll kind of weigh on what spending will look like over the longer term. So if you have any questions, you can find us in the comment section or follow me on @MarkFNY. We always enjoy the back and forth. We hope here that you have a great weekend, and thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.